and welcome. My name is Silvia Pavoni, Economics Editor of The Banker. I'm joined by Verleyen, who is the Chief Investment Officer of Societe Generale Private Bank in Hambros. Eric, last year was an incredibly volatile and unpredictable year, and I know that your research team ended that year saying that 2013 was going to be the time where to take more risk. Have you seen investors actually following your advice?
Hello. I said, yeah, 2012, looking back at 2012 actually, is actually quite surprising because when you look at the final performances of the main indices, such as the S&P, for example, or the DAX, you would see plus 30% for the DAX, plus 13 for the S&P, and plus 6 for the FTSE. Does it reflect what has really happened last year? I don't think so. You can remember last year, actually, some people felt that the euro will disappear. You remember that the IMF had to bail out, actually, some European countries. We had some issue with the fiscal cliff, and we also have ultimately some geopolitical issue with Iran. So a very volatile year, but at the end, a very positive year in terms of investments. On the bond portfolio, you also have some good performances with, a balanced portfolio having a double-digit performance. So what to do now after that? Is it too late to invest? Well, our view is that it's still time to invest. And so I would say, yes, 2013 is definitely a year to increase risk.
Are you seeing a shift in interest from a certain asset class into another one?
Bonds have been particularly good last year. This year, it's not going to happen again. So if you want to have some performance in 2013, you need to increase your risk a little bit and turn to equity. Equity is a bit riskier, but there are some very strong supports. It includes some macro. The world is actually picking up. If you look in terms of PMI, the activity, the world activity, the level is now at 51.5, and you must know that any figures higher than 50 is actually expansionary. Mm-hmm. China is going well, the US is also going well. So there are some very good support for the economies. If you look actually at the technical aspects, well, last year we had a good market, but very low volume. So there's still a lot of cash on the side, which were not invested in equity. So here, a strong support again. So yes, it's happening gradually, but it's not finished, and it's only the beginning. That's our idea.
Okay. And do you expect this available cash flooding certain markets more than others? What are the markets that interest you more at the moment?
Yeah, I think I've mentioned China, for example. We think money will go back to emerging market. We've seen some outflows last year. We think now that investors are going to be focusing more on fundamentals. Last year was about looking at the risk scenario and fears. This year is going to be about fundamentals. So yes, there will be some money in emerging markets, and we like it. We still think China is actually quite cheap, considering the level of growth. But we also like the US, where the US, you have the real estate picking up. If you look at the prices, over last year, actually, prices have increased by 4%. Real estate is very important for the American consumer. It's very important for the economy, also for the banking there, which had a great exposure on real estate, as we know. If you look at unemployment, the unemployment rate is also decreasing, very positive. The US is creating some jobs. And not to mention in the US what's happening with the shale gas and the energy price revolution, where you have actually a regain of competitiveness for the US corporates. So very good news there. So I would say emerging US and maybe Europe also. The situation in Europe, yeah, I mean,
let's talk about Europe.
It's not very popular, Europe
yes,
is not very popular.
Let's see, what are the good news coming from
Europe?
The
good news for Europe is that Europe is not deteriorating anymore. And this is a good news because, I mean, people were so bare on Europe and discounting so much, so many bad news. Now we feel it's over, and the lowest point have been reached. So I'm not saying there are not going to be volatility in Europe, especially because, I mean, come on, we know that the issue for the deficits for European countries hasn't been solved, okay? The central banks, they have actually helped the market to stabilize, and that's That's their job in a sense. So now it's going to be the time to work for the governments to cut their deficit and work on their budget. Having said that, if you look at the corporates, which are more and more exposed to the emerging markets, they might be able to deliver some good results. And as they are based in Europe, they suffer from a discount. We think that slowly this is going to disappear. So even in Europe, you may find some very good stocks to invest.
So now is the time to choose and pick certain stocks inside Europe. So let's see whether...
Exactly. I mean, you're bringing a very interesting point, which is correlation. Last year, everything was correlated the same way. Even if you were choosing the best stock, you would perform, kind of poorly with the market. Now we think investors are going to be focusing on fundamentals, as I said, of countries, but also on companies. So there will be actually a lower level of correlation among assets, and it's time to be picky.
Excellent. Now, as the last question, I also wanted to mention the impact that all these waves of quantitative easing and very, very low, close to zero interest rates in the developed world had on emerging markets and all these big talks about currency wars. So what are you going to expect in the currency space?
I think, it's very difficult to talk about the currency wars, but we can see that there are some, big movement happening. Especially, we see that the yen is depreciating. Japan has suffered from the strong yen for, a long period. So now actually bringing in an inflation target from their central bank is actually very positive. It has a very positive impact on the stock market. Actually, we've seen that it's performed very well. Of course, on the other side, it is an issue for other countries, such as, for example, in the short term, Korea is suffering from the yen actually depreciating. Korea is losing competitiveness. If we turn now to the euro, we think that the short-term euro appreciation we have seen will not last that long, actually. And it is more related now to the fact that people have been investing or started to invest in Europe. As I mentioned, Europe is not deteriorating anymore. So, but at the end, the US, for example, is really doing better than Europe. So the anticipation of any rate hikes in the futures that would come in will be more in favor of the US. So that means that the US dollar should appreciate against the euro.
Wonderful. Thank you so much for your comments.
Thank you for inviting me.